Hey everyone, welcome to my channel. I'm Rohan Sen, a software engineer by profession and an investor by choice. Today, we are going to break down the current global stock markets, focusing on the US, China, and India. We'll discuss recent rate cuts in the US, the economic reforms in China, discuss about the investment landscape in India, the FPI inflows despite inflation, and whether we might see a rate cut here soon. Plus, we'll talk about where the best opportunities might be for investors right now. Remember, this is not a financial advice and I'm not making stock recommendations. Always do your own research and consult with a financial advisor before making any investment decisions. Also, if you find this video helpful, make sure to hit that like button and subscribe to the channel for more market insights. Let's get into it. Let's start with a broad view of what's going on globally. Central banks across the world are cutting interest rates to stimulate their economies. The US Federal Reserve has recently cut rates to balance inflation control and maintain economic growth, while China's central bank is cutting rates to re-energize its slowing economy. These rate cuts are generally seen as a way to lower borrowing costs, encouraging businesses and consumers to spend more, which can boost the stock markets. However, as always, there's a lot more happening behind the scenes that investors need to be aware of. But we can't talk about global markets without bringing India into the picture, where foreign portfolio investors have started showing renewed interest. India's strong growth outlook, despite current inflationary pressures, is attracting attention from global investors. Let's focus on the US first. The Federal Reserve's decision to cut rates is all about managing inflation while ensuring the economy continues to grow, especially as the country heads into the upcoming elections. Rate cuts lower borrowing costs for businesses, which can help drive corporate earnings and in turn boost stock prices. And during election season, the stock market conditions are kept favorable to boost voter confidence, just in the same way the Indian stock market rallied before the elections. But while these can be positive for the market, they are just one piece of the puzzle. There are several other factors we need to consider, including corporate earnings, geopolitical risks, and market sentiment. Corporate earnings are the lifeblood of the stock market. With lower borrowing costs, companies, especially those in interest sensitive sectors like the real estate, financials, and technology, can invest in growth. This boosts their earnings, which can lead to higher stock prices. However, weak earnings reports, even in a low rate environment, can be a red flag for investors. So, it is important to track quarterly earnings of major companies to see how well they are performing in the current climate. Geopolitical risks can have a huge impact on the stock market, regardless of what's happening domestically. Right now, tensions between the countries like Russia Ukraine or Israel Iran Palestine, trade disputes, and other political events are key risks. Even if rate cuts support domestic growth, external shocks like these or sanctions can cause market volatility. For example, multinational companies with global supply chains might face disruptions, affecting their stock performance. Keeping an eye on global events is essential for navigating these risks. Lastly, market sentiment can play a significant role. Even with rate cuts, if investors are feeling uncertain about the future, the economic growth, or worried about geopolitical risks, they may pull back from the market. As the US elections approach, the market sentiment could swing based on political developments, leading to more volatility. On the other hand, if sentiment is positive, we could see a market rally as investors gain confidence in the future. Now, let's move on to China. The People's Bank of China has also cut interest rates, but their reasons are a bit different from the US. China is dealing with slower growth, especially in sectors like the real estate, and is using rate cuts to stimulate domestic consumption and business investment. China's stock market has been underperforming since the COVID times, but these rate cuts could present opportunities for long-term investors, particularly in technology and consumer goods sectors. However, regulatory challenges and geopolitical risks are still present, especially with recent government crackdowns in the tech industry. While there's potential upside, it is important to be cautious and aware of the risks that come with investing in China. If you follow the Hang Seng Index, you can see how well the index has performed in the past week. But the index is still available at a 3-year-old price, which is around 21,000. Considering the 5-year high at 30,000, it still has a good runway if conditions are favorable. You can take a buy and dip strategy or continue doing SIPs and keep a 5 to 7 year investment horizon to reap great profit. Now, let's shift the focus to India, which is gaining momentum as a key market for foreign investors. Despite inflationary pressures, FPIs have been increasing their investments in India, attracted by the country's strong long term growth potential. In September alone, FPIs have poured in 57,000 crore in the Indian market, making it the highest inflows in 9 months. India is currently dealing with elevated inflation, which is keeping the Reserve Bank of India from cutting the interest rates for now. However, if inflation comes under control, there is a growing speculation that the RBI could cut rates in the near future, further boosting the market. India's sectors like IT, financials, pharmaceuticals, and infrastructure are particularly attractive to foreign investors, and any potential rate cut would make the market even more appealing. Keep an eye on the inflation data and RBI announcements in the coming months, as they could influence investor sentiment and market performance. If you're enjoying this content and if you think I have earned it, don't forget to like this video and subscribe to the channel so you never miss an update. So where should you consider investing right now? The US market presents a strong opportunity, especially with rate cuts and election year dynamics potentially driving growth. Sectors like semiconductor, technology, and financials are worth watching. China offers long-term potential, particularly in tech, consumer goods, and EVs, though it comes with higher regulatory and geopolitical risks. The recent rate cuts may provide a good entry point for investors with a high risk tolerance. India is emerging as a top choice for FPIs, thanks to its strong economic fundamentals and long-term growth prospects. But this can easily shift to the Chinese side if conditions are more favorable in the coming days in China. In India, if inflation slows and the RBI cuts rates, the Indian market could become even more attractive. So you can invest with caution in India, but keep a long-term outlook. Remember, these are not stock recommendations, just insights based on the current macroeconomic conditions. Also, do your own research and consider speaking with a financial advisor before making any investment decisions. Thank you so much for watching. If you found this video helpful, don't forget to like and subscribe for more updates on global markets and investment strategies. Going forward, I will make in-depth videos for each of these markets. Let me know in the comments if there is any specific topic you'd like me to cover in the next video. Until next time, stay informed and stay invested. Thank you.